This is mainly a conversation about cost of capital and how capital is invested. And I had met a young man that's straight A's 4.0 at the University of California, San Diego. Very smart guys in finance and real estate. And first of all, we were talking about crypto, and I said, he didn't know very much about Ethereum, knew a lot about Bitcoin. And I said, well, you know how like Ethereum raised its capital? And I went through the story with them that they got on Reddit channels and sent emails out, and Bitcoin came in and Ethereum went out. But when the Ethereum went out, it was just software. I said, another way to think of this is, back in the day before you were born, we used to get Windows 95 on a CD and like insert it in our computer, and you could buy the software or you could buy Microsoft stock. When you buy Ethereum, you sort of get both at the same time. And he was like, wow, I never thought of that. So I'm going through this somewhat obscure thing called the Q ratio. It has nothing to do with Q anon. But you'll get a kick out of some of the things that DeepSeek said. Okay, the user is asking, this is the thinking that it does for 13 seconds. The user is asking for a Q ratio analysis of Tesla stock. This is a pretty sophisticated financial request. The Tobin's Q ratio isn't something retail investors typically look at. Let me unpack this carefully. First, I need to consider who might be asking this. Could be a finance student working on a project, or maybe a serious investor doing deep fundamental analysis. The directness of the question suggests some financial literacy, but I should still explain concepts clearly. I'm going to skip around a little bit, forgive me. I recall that Tesla's 10K shows net property and equipment around 37 billion. Just take that number in for a minute, because it had a market cap a couple of years ago of 1.2 trillion. All right, so I'm going to go down and give you the answers. The reason I'm going through this, by the way, is because I think we're going to live through this thing in the next couple of years, where we differentiate between market cap and actually capital committed. Because what's going to happen as we transition into these AI systems is these are enormously capital intensive. The President of the United States said it's going to be $500 billion. And they're doing it in the Middle East, in Texas. There's already huge data centers in places like Northern Virginia and Utah. There's one that I think is 120 acres. But my thesis in this is that Tesla is not a car company in the way that we think. So it did the market cap at 560 billion, which is the recent number. It brings it to a Tobin's Q ratio of 5.5, roughly speaking. And it used net book value of $109 billion. So it'd be like property, plant, and equipment, IP. It gives it a little bit of a boost because they have some special battery technology, etc. So, but just to compare that to something, of its own accord, it compared Tesla at 5.5 to Toyota at 0.37 and Ford at 0.18. Hold on. And NVIDIA at 35. In other words, the differential between the actual capital that was committed to these things, whether it's Toyota or NVIDIA, are enormously different from their market cap. And so if we had to go reproduce the TSMC facility in Taiwan or build a facility like BYD, which is bigger than San Francisco, that's not done by just jerking off market cap. That's actual real money that gets invested in real things. So, conclusion. Tobin's Q flags Tesla as overvalued based on physical assets alone, but this ignores its technological moat and optionality. Use Q as a sanity check alongside growth-focused models. For Tesla, traditional valuation metrics are often secondary to narratives around autonomy, AI, and scaling. Now, the worst one was whenever I asked it to take the market cap divided by its current earnings. just because it popped up. If you bought Toyota outright and took all the net income as a dividend, it would take you 7 years to get your money back. If you did that with Ford, it'd take 11 years. If you did it with NVIDIA, it would take 90 years. It's basically the PE ratio. So, give me just a second. So then I asked it to do the market cap at its all-time high was November 4 of 2021 versus the earnings. It would take at that moment, it would have taken 221 years to get your money back. Basically, the PE ratio and the time to get the money back from the net income are the same thing. Give me just another second. At its peak, Tesla traded for 58.74 times book value, price to book. Now, the reason, again, I'm going to repeat myself, I think as we move into the AI story has been told as though it's just software, because it makes software. I actually did a project. I said, just go make me an app and write the software, and it just goes blah, 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 and starts writing code. Problem is that they're not software companies. So we're going to have a moment where we look at something, let's say like Microsoft, which just laid off, I don't know, 40,000 people who write code, and they're going to replace them with AI. The problem is all these companies that our stock, the NASDAQ is based on, are now going to have to go invest in enormous amounts of actual real capital. They can't just make the stock price go up. So, have a nice day.